Hello, everyone, and welcome to the first lesson in financial innovation and fintech. In this lesson, I will cover the introduction to financial innovation and fintech. I begin with what financial innovation is. Then we look at its evolution, how fintech drives financial innovation, the main areas in fintech, and how fintech startups are transforming and adding value to the different fintech areas. Financial innovation occurs if there is the development of new financial products, services, technologies, or institutions. Therefore, credit cards and ATMs, for example, will be considered as historical financial innovations, while recent financial products such as ETFs, cryptocurrencies, blockchains will be considered as recent financial innovations. We can also consider mobile money services such as Zelle, PayPal, and then chatbots as recent innovations in financial services. All these financial innovations enhance customer service quality, makes financial services more accessible, for example, to underserved populations. Now, some of the fintech innovations allow for more efficient financial services by making services more automated, by expanding financial access, thereby boosting revenues. Financial innovation and fintech have evolved tremendously from the double entry accounting to the stock market, the development of derivatives, securitizations like asset-backed securities, and electronic trading platforms. Let's look at the evolution of fintech from 1967 to 2008. And this would be the first significant period of evolution of fintech. So in 1967, the first ATM was established, and then Texas Instruments launched the first handheld calculator. Then from 1960 to 1970, within that period, we had the launch of payment systems such as SWIFT, which allows financial institutions to efficiently and securely do international transfers across countries. 1971, we had the first electronic stock exchange, that's the NASDAQ. Now, beginning of the 1980s, most banks in developed countries migrated to computerized systems. From the 1980s, there was a major evolution in the financial innovation and fintech space with the development of the internet. Now, the internet opened up email and internet services, which in turn have facilitated online businesses such as online banking. Other major milestones in the evolution of fintech are Black Monday in 1987, the internet and dot-com bubble crash in 1999, and the 2008 global financial market crash, all of which opened up the financial services sector to innovation as a result of new regulations that were passed to reform the financial services sector. So these new regulations created opportunities for fintechs to flourish. From 2008 to the present, we've had significant evolution of fintech. There's been more regulations being passed, increased compliance costs, and decreased profitability as a result of that. Many employees have lost their jobs and ventured into fintech startups offering innovative financial solutions. There's also been the emergence of cryptocurrencies, mobile payments, crowdfunding, initial coin offerings, and these are for cryptocurrencies. That's the IPO for cryptocurrencies. We've had peer-to-peer lending and data-driven finance. So how do fintechs drive innovation? Fintechs drive innovation by leveraging technology to offer more efficient, accessible, and user-friendly financial services. Fintech startups are more agile in that they embrace flexibility and continuous improvement. They have a mindset focused on innovation and responsiveness. Therefore, they are able to adapt quickly and effectively to changes in the market and customer preferences. And as a result, they are able to develop products and services that meet customer and market needs. Digitization drives financial innovation by streamlining processes such as the operations of a business to make it more efficient. Digitization drives financial innovation by reducing costs, improving accuracy, and enhancing customer experiences. For example, digitization drives digital banking, which enabled banks to allow customers to open accounts, apply for loans, and manage their finances online. Let's now look at what is driving fintech startups and the fintech industry's growth. One is technological evolution. Other is changing customer expectations. And we've highlighted this point. As customer expectations change and customers have more needs that could be met, that creates opportunity for fintech innovation. The availability of funding is critical. And funding from venture capitalists, for example, have driven the formation or establishment of fintech startups. And last but not the least, increasing support from governments and regulators also drives the fintech innovation and the establishment of fintech startups. Let's now look at the main areas of fintech. The first area we're going to look at is payments and transfers. Now, within the payments and transfers area of fintech, we have innovations such as mobile payment apps and peer-to-peer transfer services. Next, we're going to look at the personal finance area of fintech. Fintech personal finance solutions include budgeting, savings, and investing. Personal finance fintechs are companies that use technology to help individuals manage their money more effectively. Some well-known examples are Mint. Now, Mint aggregates financial accounts and tracks spending, budgets, and bills. Other examples of personal finance fintechs would include Acorns, which rounds up purchases and invests the spare change. Then we have the Credit Karma, for example, that provides free credit scores, credit reports, and personalized credit card and loan recommendations. The third area of fintech that we're going to look at is the lending area of fintech. And here we have peer-to-peer lending services, such as Lending Club, which allows for individuals to lend to other individuals. And we have online lending platforms that provide more accessible and flexible borrowing options. Let's continue with our discussion of the main areas of fintech. The next area of fintech we're going to look at is asset and wealth management. Within asset and wealth management, fintech innovations automate investments and enhance personalizations. And an example will be robo-advisors, and we'll touch on that in more detail in subsequent lessons. Within the insurtech area, we have fintechs streamlining the processes and enhancing customer experiences in the insurance industry. And next, we're going to look at RegTech, which are fintechs that help financial institutions to comply with regulations more efficiently through the automation of that process of compliance and the use of advanced analytics. Fintechs have had a profound impact on traditional financial institutions by, for example, making banks increasingly adapt to the changing landscape by embracing digital transformation and innovation. Challenger banks, also known as neobanks or digital banks within the banking space, have disrupted traditional banking by offering faster, cheaper, and more convenient services. So what are challenger banks? Another name for challenger banks are the neobanks or digital banks. They are digital-first financial institutions, and they pretty much are focused on disrupting the traditional banking space by offering innovative, user-friendly services, often at a lower fee. And then, of course, they also offer faster account opening processes, primarily through online or mobile apps. And this expands services to previously underserved banking populations. Fintechs obviously provide strong competition to banks and arguably force many banks to embrace innovation. Now, another perspective about fintech's impacts on banks is that fintechs and banks can actually partner and leverage the competitive advantage of each other. So bearing in mind that fintechs have a strength in innovation, business agility, and talent, whereas banks have a key strength relating to their access to customers, scale, access to substantial financing, and expertise in regulatory compliance. So these strengths can be leveraged when the two come together in the form of a partnership. And there are increasingly examples of fintechs partnering with traditional banks. Let's now talk about the Open Banking Initiative. The Open Banking Initiative is an example of how new rules could drive the fintech sector and drive innovation. Now, the Open Banking Initiative pretty much increases consumer choice in the banking system and makes the banking space more competitive. Customer data is portable as a result of adoption of the Open Banking Initiative. And I must mention that in North America, the Open Banking Initiative is yet to be adopted, but the world is increasingly moving towards adopting the open banking initiative. Under the open banking initiative, which requires that customer account information will be portable, APIs are very important. APIs are application programming interfaces, and these allow fintechs to access customer data stored within bank systems, enabling development of third-party financial applications. And APIs support the objective of the Open Banking Initiative, which is to make customer account information portable. Recognizing that the world is moving towards adoption of the Open Banking Initiative, it's just a matter of time, financial institutions are actively enhancing their digital offerings to align with the open banking advancements and, of course, the passing of the open banking rules. For instance, HSBC, which is one of the largest financial institutions, is rolling out a significant update to its mobile banking app, introducing features like spending categorization, financial insights, and open banking integration to allow users to view financial products from other providers. Let's now look at how fintechs have grown and the current market value. Well, fintechs have grown significantly over the past decade. And the market cap of fintechs, combined market cap, as of July 2023, was a whopping $550 billion. And over 272 fintechs have a combined valuation of $936 billion. Fintechs are constantly innovating, and fintechs are able to constantly innovate by leveraging cutting-edge technologies such as AI, blockchain, and machine learning to offer innovative financial services. And as a result of these cutting-edge technologies that have been leveraged, fintechs have provided innovations in areas like cross-border payments, digital wallets, and personalized financial planning. Let's now look at the key trends shaping the current landscape of fintechs. We have a diverse array of fintech startups to large tech firms, all seeking to innovate and disrupt the financial sector. And we see a growing adoption of AI, blockchain technology, and big data analytics. There's also a trend towards being more customer-centric by fintechs. And by so doing, fintechs offer convenient and cost-effective services, such as attractive rates, easy access, and a variety of innovative products. And of course, meeting such needs of customers translates to revenues and boosts the value of fintechs. There's also varying global adoption of fintechs. So China and India are leading the way with high fintech adoption rates, while others like France and Japan have lower adoption rates. Another key trend shaping the current fintech landscape is the regulatory environment. Regulations are becoming more and more complex. And as regulations become more complex, it provides opportunity for fintechs to innovate, to help companies comply with these complex financial regulations. Fintechs are also increasingly shifting their focus toward sustainable and profitable growth, especially after years of rapid expansion fueled by venture capital and a growth at all costs mentality. So what accounts for this shift? The market correction and the funding slowdown. With the slowdown in venture capital funding, for example, there needs to be that shift. There's also global economic uncertainty and rising interest rates that have cooled down venture capital funding. So we see also that many fintechs have moved beyond the startup phase. And with scale comes the pressure to show stable revenues and margins. So what makes fintechs valuable? Why are they so beneficial? Well, fintechs provide innovations that extend beyond mere convenience. Fintechs, we've seen, have the potential to promote financial inclusion by making it possible for underserved populations to also have access to financial services. And related to that, fintechs enhance financial literacy through educational tools and resources. I hope that you have enjoyed this introduction to fintech lesson. Now that we have introduced fintech and financial innovation, I look forward to taking a deeper dive into the various areas of fintech with you in subsequent lessons.